What the heck'em is a reverse mortgage? It's a good joke. It's like a dad joke. HECM, HECM, stands for Home Equity Conversion Mortgage. Kind of a dumb name. More commonly known as a reverse mortgage. So what is a reverse mortgage? Somewhere around here, there's a link that takes you to the overview of what a reverse mortgage is, where I do a video that kind of gives you this. This video, we're going to go deep. We're going to do an actual presentation. Yeah, there's going to be some slides, a lot of slides, but it's going to be the deeper dive as to exactly what reverse mortgages are, how they can benefit. We'll give some real life examples, and we'll go through each one as to why these can be valuable financial tools to somebody that does qualify for them. So understand this, my personal opinion and professional, right? I've been doing mortgages for a long, long time, since 2003. So for a long time, reverse mortgages are amazing for the right person with the right circumstances. They're not for everybody. Just because you qualify for it doesn't mean like, oh, let's go get it today. So it's typically designed to help someone create some cash flow or access to cash that needs it. They do need or want to have a sizable amount of equity in a home. So it's a way of tapping the home's equity to help you then, live many years at a different financial ability, right? So for those that have just gobs of money in the bank and all this other stuff, maybe it's not the right move. But for those that need it and want it, it's a wonderful tool. And it is very much, in my opinion, a need-based mortgage. So before I get started, let me say a couple things. I'm sure compliance would want me to, but the reality is this: you just need to know that obviously this is going to be very unique to the individual. Whoever's going to be owning the home, it's going to be unique to them. So what I'm going to go over is very generic, not a generic, but overview of what it is. It's not applicable to anybody. It's not a commitment to lend on our part. We're not sitting here telling you here's what the rates and cost are. We will throw a few examples out just so that you have a reference for it. Consult, a financial person, whether it's both mortgage or financial planner, advisor, or somebody you work with. If you have additional questions, always we'll give you our 2 cents. And the Mortgage Mark team is very dedicated to make sure we give you all the options beyond just what's available. So yes, a reverse mortgage might be available, but there very well could be other better options as well. So understand that if you do have questions, please reach out to us. Their mortgage companies, all the ones I've worked for, and I'm pretty sure most in general, do require special training for reverse mortgages. So much so that we will have somebody, not me, I will make sure somebody on the staff not only has gone through the training, but is really proficient. Like they're to the point where this is all they do. Right. So we want our professionals to make sure they can talk to you and your family members to clearly explain what's going on. And it's so complicated that the FHA, governing body of these things, they actually do require counseling. So understand that there's a lot that's going to go into this. My team and I can help you. Absolutely. But just understand it won't be me. And that's a good thing because we want somebody to do this right. So we're going to jump into the boring section of the slides. I'll do my best to try to keep it quick, not to bore you. But again, this is really good intel. So if you want to go deep, this is the video for you. If you just want the overview, somewhere around here, there's another link or a page that you can check out. So ultimately, let's talk, what reverse mortgages are and what they're not. So it is a way. So a normal, I'm going to use air quotes here that you can't see, quote, normal mortgage is a forward mortgage. A reverse mortgage, it goes backwards. Like balances can actually increase with this. So there's what's called a principal limit. That's essentially kind of what determines the loan amount and how much access to cash somebody has. And that's going to be based on the home's, the amount of equity in the home, as well as the age of the home occupants, the homeowner. It is for a primary home only. And then ultimately it can create some flexible payments. You can have it so that somebody can pay no payments, which means the balance can actually increase over time. So meaning like, hey, this, like not just this month, but forever. If I don't want to make a payment, I don't have to. I'll still have a mortgage. But what happens is every month, whatever interest would be due, it just gets tacked onto the mortgage. So that every month that balance grows and grows and grows and grows. The neat part about reverse mortgages is that balance can grow forever. If somebody lives to be 165, good for them, that balances grow. Even if the home's not worth that much, the balance will continue to grow and allow that homeowner to not make a mortgage payment. That is really, really cool. Now, again, you may say, man, how does that sound right? And what about like my kids or my heirs? If you live to be 165 and don't have a mortgage payment and the mortgage is worth more, than the home at the time of the occupant's, demise, the kids are not responsible. It's a non-recourse loan, so the kids don't need to worry about it. Another option, payment option, so besides no payment, you can make an interest-only payment, which then keeps the balance where it's at because you're not paying principal, but you're not adding a balance to it. A third option is you can actually pay the normal principal and interest and have the balance go down. And what's really cool is with options you can pick and reverse mortgages, you can stop and start payments. You can say, I'm not going to make one, or I do want to make one. So it offers a ton of financial flexibility so that the homeowner can really just choose what works for their financial needs. The thing to note, by the way, is that a homeowner is still responsible for property taxes and homeowners insurance. You don't get to avoid that just because you got a reverse mortgage. You still got to pay those things. So if you don't, they will come after you and your home could get foreclosed on. But just pay your property taxes, pay your homeowners insurance, because it's not going to be the mortgage company's job at that point. So it really offers a lot of control, flexibility, things of that nature. So the reasons, as I mentioned, for a mortgage or a reverse mortgage is to just allow the homeowner to access cash, right? So aside from just being that it's money, it's tax-free money because it's not income. It's your money. It doesn't impact your Social Security qualifications or your Medicare. It's your cash, tax-free. You're just pulling money out of the home. And ultimately, you don't have to pay it back at your demise. If there's equity still in the home gets sold or refinanced, then certainly the mortgage will get paid back. But if it exceeds the value of the home, you don't have to pay that difference. So who qualifies? I mentioned it's for folks 62 years of age or older. For jumbo programs, they actually allow it to go down to 55 years or older. But for the most part, let's just talk the 62 years of age and older. We'll give an example of each, normal and jumbo, so that you guys can see it. Properties, normal properties, right? Single family homes, whether it's a duplex up to a fourplex, condos, they got to be approved through FHA, some manufactured homes, townhomes. So ultimately kind of the normal housing, eligibility requirements are included there. Underwriting requirements, typically not as strict or restrictive compared to normal traditional underwriting. You still have to have some credit, qualifications. You still got to have some income qualifications, but they're not nearly the same as what you might find in a quote normal mortgage. So this is, I don't even know. I debated about even throwing this in there. It just kind of shows how you can do different things, right? On the left side, you got the normal, air quote, normal reverse mortgages. On the right side, you got the jumbo stuff. You can do both purchase and refinance. You can do both fixed rate interest rates and adjustable interest rates. So there's a whole lot of options. And again, it goes back to work with somebody you know, like, and trust. Have them walk through these options with you so you know what you're doing and what's best for you. So on the refinance, you can choose things where you get like what's called the tenure, right? Where it's like equal monthly payments for as long as you live, for the life of somebody on the home, right? Even if one of the spouses passes, it still keeps going. The term, right, for a fixed period of time, think of like a normal mortgage. You can have it to where it's like, okay, for this amount of term, I'm going to have this equal payments. You can do lump sum, like cash out. Like you can say, okay, give me this many dollars or give me a line of credit that gets me access to these cash. So it's, again, a lot of different options inside these things. So here's an example. Again, this is not a commitment to lend. This is not guarantee of the rate. Rates change on a regular basis, et cetera, et cetera, et cetera. But let's take a scenario. So 74-year-old unmarried lady. She's got about 190 grand in her 401k. That's awesome. Good for her. She's got a current job making about 40 grand a year, but she wants to retire. She's been working a long time. She'd like to retire. I'm all for, let's do that. But it'd be hard to do that when her, once that 40 grand goes away, her then Social Security income of 1640 could also go away, right? So she's got the Social Security, not goes away, I'm sorry, but 1640 exists, but all the other income goes away. She may have a hard time paying bills considering the fact that her current mortgage, which is 170 grand, has $1,000 a month payment on it. So she would like to retire, but it's hard to do so with that kind of cash flow. So the home's value in this example is 530 grand. So the problem, as we just mentioned, wants to retire, and she doesn't want to take all her money out of her 401k to then pay off the mortgage because that would leave her about 20 grand left. She still needs to live. And again, the cash flow each month from Social Security may not and probably won't cover all the bills. So the goal here is to create some cash flow, right? Some disposable income. She also, by the way, wants to upgrade and do some updates to her kitchen. And then lastly, she wouldn't mind having some access to cash in case life happens in the future, because life does happen, unfortunately, sometimes good, sometimes bad, but it does happen. So the solution, we got a $319,000 reverse mortgage. That's the FHA HECM, right? Reverse mortgage. The rates, it was there at the time. Those are super, super great rates. That's not necessarily where today is at the taping of this market. The market is at the taping of this video, but that was where it was at the time. And for the mortgage, she now has this $170,000 mortgage, but she's going to get it to go away. And so does the $1,000 a month payment, because she's now got a $319,000 mortgage. So in taking that mortgage up, she's done a couple things. She's now gotten 31 grand for her kitchen upgrades, almost 32,000. And she's now got a line of credit for almost 104. So that if she needs cash in the future, she has the ability to draw on it. But more importantly, no payments. So yes, the 319 will grow up over time as she's not making payments. The interest charge is added to the balance. But now she's able, with her 401k of 190 grand, their Social Security income, no payments, and access to a line of credit, it suddenly makes it to where it's like financially she's stronger and able to support herself and doesn't have to rely on anybody else or getting into financial troubles or selling her home and worry about doing all these different things. So it can be a wonderful scenario for somebody in this example. Some advantages, we kind of just hit on those things, but again, it increases the cash flow because there's no monthly payment in that example, right? The interest, you get to postpone drawing down her retirement, right? So she preserves her interest, or pardon me, investment, not interest, her investment in her 401k. She doesn't have to use her accessible cash now. She even got access to more cash to fix her house up and for the line of credit just for a just in case. So that's always cool. And then again, the third one, just the timing. If your stock market, because you never know when people are looking at doing this, but if the stock market's just gotten beat to heck, you don't want to sell when everything's down. And conversely, you may not sell when everything's up because you got a whole bunch of tax consequences. A couple other things you guys can read. I'm not going to go through all of them, but I thought those are the really kind of the key points here. Here's another scenario. This one's the jumbo scenario. So you got two folks, an attorney and a therapist, $4 million house in California. Good for them. And they have two mortgages. So call it $1.5 million, give or take, and they pay about $8,600 a month on these payments. So now what they want to do in this case, the problem, they want to get rid of the mortgage payment. And because again, they're 76, 79 years old, they're looking to maybe slow down and do things. But unfortunately, hubby has Parkinson's disease. So now they're going to have increased medical costs and expenses just to help him unfortunately just deal with that nasty, terrible, horrible disease. So they do need to create some cash flow and get rid of that. So in this instance, again, they work and they go through and they get the mortgage where now they no longer have a mortgage payment, right? And so also in this example, they just happen to have a big old profit sharing plan. So they can kind of work with a financial planner to then go through this process, couple this mortgage with the financial plan to then create the cash flow, because more important than just, oh my gosh, I'm paying a few extra bucks in interest because it does get added to the balance. Who cares? Because they need to take care of hubby and his unfortunate disease. So you can see the difference down below, the result, right? The $2 million reverse mortgage. It was an adjustable rate. Again, that was a really great rate at the time compared to today's when I'm taping this, but it's $1.5 million for the mortgage payoff. So now they eliminated that 8,600 and they also got a $500,000 line of credit that does grow as time goes on, because as they get older, they get more equity to the cash. So they got those funds available to them for the next 10 years. So that $500,000 line helps cover any potential future expenses, things of that nature. Again, this can be a really great solution for somebody that has equity, that needs a sudden increase, maybe not even sudden, but just an increase in cash flow or just flexibility with their cash in general. So these are some details about the purchase program. I won't go through all of it. A lot of it's kind of what we just talked about, but it's, helps folks with their cash flow, access to the cash, and also it can provide more purchasing power. I'll show you that here in the next second. So this is a $800,000 reverse mortgage purchase example for a 72-year-old borrower. So the FHA, so people say, well, what are the costs? Well, in this instance, FHA does have upfront mortgage insurance for reverses at the time of this taping is 2%. So on an $800,000 purchase or reverse mortgage rather, you're going to have a $16,000 fee to FHA. And you can say, man, it's a lot of money. It is. It really is. But guess what? FHA takes it on the chin whenever somebody outlives their projected actuarial tables and they outlive this to where the home becomes less value compared to the mortgage. So that's part of that insurance that helps cover that cost and that when that happens. Next example, using rough numbers. So again, please know that these are not your fees. These are not there. These are just example type fees. But you got origination, you got some title fees and all that stuff that goes with it. So you can see this $800,000 becomes $823,000. Their loan amount in this example, based on everything we just described, and you plug it in the system, they got a loan amount for about 273 grand. So when they do that, their required cash to close is 523,000. So you can say, my God, that's a lot of money. It is. It's a ton. Like I said from the very beginning, these are for people that either have a ton of equity or a ton of cash, because instead of having now to pay 800 grand out of pocket for no mortgage payment, they now only have to pay 527,000. I mean, that's a massive 200 and close to $270,000 difference of cash to get to keep in their pocket to use to pay for life. So it is a great opportunity. From a liquidity standpoint, kind of going through the same thing. This is, slightly different numbers, but now somebody doesn't have to pay a ton of money. They can be 72 years old, sell their home for 850 grand. The first example shows that if she were to buy a $700,000 home, and if she were to pay cash for this thing, she would have to pay and get the proceeds that she got from her sale of 850 grand, pay cash for the $700,000 home. It's now 82 grand total left in her pocket. If she were to get a reverse mortgage, you can see the difference. And now the funds she has left over significantly more than what she had. I mean, 319,320 essentially gets to stay in her bank account to now use for living purposes. So real quick pause on this. This is a great example of a reverse mortgage. However, not to say that this couldn't be achieved. The same scenario could be achieved with a quote normal traditional forward mortgage. So understand this is a great option, but if she can't qualify for a forward mortgage, because remember the qualifications here are less stringent, then that may be a reason why reverse mortgages come into play. But this is a great example of when it can work, but there may be an incident based on her qualifying that if she could qualify, a normal mortgage could maybe achieve some of these goals as well. So again, I don't want to just make this be like a blanket, like, hey, it's the same right mortgage for everybody. It can certainly have its right place to be. So again, going back, one last example I mentioned earlier about just it gives you more purchasing power. If you got a $400,000 home that somebody, sells their home, or they got 400 grand to buy a home, with a reverse mortgage, they can buy a $400,000 home because they don't want a mortgage payment. With a reverse mortgage, they can buy even up to an $800,000 home, use the 400 grand or keep the 400 grand depending on their age and what's going on. But it gives you the ability to buy a home that might be more suited for them and wherever they want to buy and wherever they want to live. So it can increase your purchasing power compared to just paying straight up cash. So lastly, a couple things, these are the myths, with the bank own my home. No, it's like any other mortgage, right? The borrower owns it. Can they kick me out? No. The only time they're going to kick you out is, when you die. They're not even kicking you out. Can I possibly leave my children with debt? Again, no. If the homeowner is deceased and there's equity in the home, just sell the home and they get the money, or refinance it. They still have access to all the equity. If they, if the home is worth less than the mortgage balance, then there's no debt. The kids don't have to pick it up. It's non-recourse, but it's there. So, and then lastly, HECMs, your reverse mortgages only used as a last resort. I used to think that. I'd like to say it's not a last resort, but it's certainly there are other options to explore. But it's something that does need to be explored. But I'm of the opinion that this isn't a like, oh man, like there's some hardcore reverse mortgage people like, you got to do this. Again, I'm not saying it's the last resort, but it's certainly down the list if there's other better, more viable options. The payoff kind of goes back to the same thing. So what if I want to sell or whatever it is? So this is more like who controls the home? The borrower does, right? So if they want to sell the home, they can, but really what happens is if they move, they got 6 months, if they move out, they're going to ultimately, if they don't live there, because it's primary homes only, they will have to figure out, how to sell it. And you can get extensions and all that. So if you move out and it's a slower real estate market, you can get extensions on it. If somebody goes to the nursing home or assisted living or something of that nature, They can do it. They can move into that and then they get better. Something happens, they move back into the home. You can do it. It just can't be longer than 12 months away from home. And if they decide to move out and they're going to keep the home, they do, like they want to keep it for a rental or something like that. Yes, you would then need to refinance or get rid of the reverse mortgage. So those are the reasons why people misconception of like, oh, they're going to make me sell my home. They're not going to make you. It's just if you don't live there, you got to get rid of the reverse mortgage if you're going to still go live somewhere else and you want a mortgage on that home. The payoff features, as I've been mentioned 2 or 3 times, it can exceed the house value if you live long enough in the home. That is okay. And ultimately, like what happens if I sell my home for more than the balance? Well, like a normal home, you get the money, you get the difference. It's your home. So the ultimate takeaways here, you just get to pick the flexibility that works for you. As I mentioned, get with your financial professional, get with a good mortgage professional, make sure you know your options. It allows you to put like your equity to work so that you can then create a flexible mortgage payment, gives you a lot of options. And again, I've said it 5 times, if not more, it's not like automatic. Reverse mortgages can be fantastic. I consider them more of a need-based. If you can't qualify, if there's not a lot of options, and it's somebody that does need it, it can make a lot of sense. But don't just say if somebody says, oh, it's a no-brainer, and it might be a no-brainer, but make sure you've explored other options with it. As always, if you got questions, reach out to the Mortgage Mark team. We are certainly here to help. And as always, when you think mortgage, think Mark.